Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with a weekly review for the week ending October 20th, 2023. Let's start with looking at this week's market action at the close on a Thursday. Negative for bonds, so higher interest rates. The market is, just getting used to the idea now that rates will stay high for a while in the US. This is mostly the Fed here that's driving the markets. Not too far back, it was 4 to 6 cuts that were priced in for the Fed in 2024, and now we're talking about between 2 and 3, which is starting to be more, let's say, reasonable or in line with the view that we have also internally, that rates could start to fall in, could start cutting rates in H2 of 2024, maybe 2-3 hikes. That seems more reasonable than 4 to 6. So markets are getting close to this idea, and also geopolitical risk premium, maybe higher oil prices feeding inflation. This is pushing rates higher. Higher rates also means pressure on the stock market, so you have negative returns for equities here across the board. Price of oil continues to grind higher, like 2% higher this week, about $90. The Canadian dollar was lower. Flight to safety towards the US dollar was the theme. USD, Euro USD a bit higher, and the price of gold higher on the week, doing its job as a diversifier when you have geopolitical risks flying around. So 8.25% year to date. This week we'll focus only on Canadian inflation. First, we had some good news this week. Let's enjoy it. On the left, you have total inflation. As you know, it rebounded recently, but now it fell a bit to 3.8%. Good news. On the right, you have goods versus services inflation. Goods inflation is pretty volatile. Was higher recently, lower with the lower price of gasoline in the last few months. But the price of services, the services inflation, continues to trickle down lower. It moves slower. Just look on the right in the 1970s, inflation in services peaks after goods inflation, and it moves much more slowly. So this is exactly the behavior that we're seeing now. Again, it's more sticky, but we need to see steady progress on inflation for services if we want to see total inflation get back to 2% in a sustainable way. So good progress this week. On the monthly basis, we've been presenting these charts for a good while, every single month. Inflation month over month was too hot for comfort since the beginning of the year. On average, about 0.4%, which was way too hot. Now we got a very strong surprise, negative surprise of minus 0.1%. So we'll take that. On the right, that does change the shape of this chart here. When you project all the way to mid 2024, if you have 0.4, 0.3, 0.2, 0.1, all of these scenarios on the right for every single month on average. Well, if you have 0.4 every single month, inflation is going to stay too hot for comfort. But if we start to move down in this distribution, then you're starting to get in a world where it's possible that we could have total inflation getting back within the target range somewhere by mid 2024. That would be conducive to maybe rate cuts in late 2024. So a very important development here. So let's see if it's a fluke, because if you're putting gas in your car these days, you know that gasoline prices are up again. So maybe this will be only a fluke on the chart. But so far, let's enjoy the news while they last. We also take a look here on the next chart at the non-discretionary components and consumption. Everyone has to eat and everyone has to have shelter. So here, if you look at both of these charts, on the left, food inflation continues to grind lower. Still too hot for comfort for sure, but continues to grind in the right direction. So good news there. But on the right hand side, rented accommodation inflation continues to shoot up. So there's a few things here. Of course, higher interest rates, it's paradoxically inflationary, especially when you go from rates that are at rock bottom and you hike them all the way to 5%. Now mortgage rates are higher, and if you're an owner of a building, well, you're paying more on your mortgage, so you pass that into the rents. And also the demographic factor is very important here. It's at play. strong demographic growth means more demand for lodging and for shelter. And here you see the rents continue to shoot up. So there's a victory, let's say victory in the making on the left, but an issue that's becoming even more important on the right. So let's see over the next few months, but let's enjoy the good news while it lasts. Bank of Canada, time to call for an end of the tightening cycle. Here you have, it looks like a big spaghetti, but it's the expectations for the number of hikes between now and all of the coming decision dates in Canada. As you can see, the trend is going lower. So if you focus on the red line, it's the next decision for October, which comes next week. So nothing is anticipated. And even if you go all the way to mid 2024, almost mid 2024, April 2024 in this chart here, you see that there's not one hike that is priced at any one of these meetings. So the market is pricing that we're done with the tightening cycle. We agree. We think it would be the best thing to do to stop hiking. There's already enough hiking, and we need to see the impact of all of that to see if it's enough. We had two, insurance hikes during the summer. Now maybe it's time to step on the to go on the sidelines and to wait for the impact of all of this to manifest itself more, so be more data dependent. So the market is not calling for any further hikes in Canada. What to watch next week? You will have the next decision by the bank next Wednesday. We'll have the CFIB Business Barometer. We'll have in the US the S&P Global PMIs, manufacturing, services, and composite. We'll have all three. New home sales should be higher, and GDP for Q3 this is the first print, should be at 4%, so an acceleration. A lot of that has to do with the growth in the budget deficit in the US. Also, the manufacturing sector is starting to get, let's say, less bad or better in the US. So we're seeing some of these signs here. Doesn't mean that the story changes for the US. The risks of recessions in 2024 remain alive, but we need to acknowledge that the 2023 was stronger than expected for sure. So that wraps it up for the week. Two places to find us: on the left, ia.ca/economy, on the right, iagam.ca. Lots of material for everyone. Always a pleasure to serve you, and I'll see you again next week.